This segment sponsored by Foster Financial. It's time for Women's Wealth Wednesday, providing you with great financial resources. I have today Caleb Doane, who is the Vice President of Foster Financial. Hi, Caleb.
Hi.
How are you?
I'm doing well. How are you doing?
Doing well, too. Yes. So I'm excited about Wednesdays because we get some nuggets and gems dropped from you. And today we are going to talk about the widow's tax trap.
Yes.
Sounds scandalous. Okay, what is this, Caleb?
Yes, so it's certainly something people should be aware of, and I know, we kind of finished some of our segments on the main things that widows should be aware of,
right.
Main kind of boxes to check off when it comes to their finances, and this relates to that, and it relates to taxes, which people are kind of in the middle of doing right now. And the widow's tax trap, or sometimes you'll hear it called the widow's tax penalty, certainly a thing we want to avoid, but it's essentially this tax phenomenon that when a couple is married filing jointly, they have a lot wider tax brackets and they get a really large standard deduction that they get to take off at the end of the year. And then if a husband passes away and then a wife is left the next year to file as a single filer, the tax brackets are now compressed and she now gets a much smaller standard deduction that she gets to take. And so there are some scenarios where if they have consistent income from year to year, her tax bracket could jump up significantly in the next year after she's widowed. And so she can end up paying a lot more in taxes. So it's just an important thing to be aware of. And there's a few strategies that can help you avoid that tax trap as well.
Okay, and is this something that a widow would be aware of? Or is it something that kind of, bam, pops out when you're doing your taxes? Yeah,
unfortunately, it's a thing that people are so used to, being married, filing jointly for probably the last, 50 years. And so they're used to those tax brackets, they're used to that large standard deduction. And so it can absolutely end up being a really big surprise for people. And so just as an example of how this could impact somebody, let's say that there's a couple, of course, married filing jointly, they're retired, maybe in their mid-70s.
Okay.
So let's say that from Social Security together they bring in right around $40,000 between the two of them. They both work jobs where they got pensions, and let's say between the two of them there's another $40,000 there. And then finally, since they're in their mid-70s, they're required minimum distribution age.
Right.
And so let's say they have to pull another $40,000 over the course of the year from those accounts. If they're married filing jointly and they get to take that big standard deduction, they would be in the 12% tax bracket. So a pretty relatively low tax bracket to be in. Now let's say the husband unfortunately passes away. The next year the wife is filing as a single filer. So let's say her Social Security dropped to $25,000. Let's say both of those pensions were joint survivor pensions, and so she still gets the 40 grand from that and then still gets the 40 grand from the required minimum distributions. So her income actually went down from last year to this year because Social Security was reduced a little bit. Her tax bracket would go from 12% all the way to the very top of the 22% tax bracket in 1 year. And if for some reason her income goes up at all due to more required minimum distributions or whatever it might be, she could even push into the 24% tax bracket. And so it seems unfair, because her income stayed the same. It's just the fact that those tax brackets are compressed and she gets that smaller standard deduction that all of a sudden she's paying a lot more taxes than what she was before.
Wow, that's interesting and something that's so important to be aware of before, because you say there are actually strategies that one can take to avoid this or to remedy it?
Yeah, absolutely. So there are a few really interesting life insurance strategies that can kind of be used with pensions, but I would say that the biggest strategy that we employ for our clients is leveraging Roth conversions earlier.
Okay.
And what those Roth conversions will do is actually reduce the amount of required minimum distributions that you have to take.
Okay.
So, for her, instead of having to pull out $40,000 and get pushed up into that 22% tax bracket, if she did a lot of Roth conversions before and we were kind of planning this kind of tax strategizing in advance, she might not have that required minimum distribution, and therefore she could stay in that 12% tax bracket.
And so would this be before, though? Is this a strategy before she's widowed?
Yeah, that's certainly a strategy before. One strategy after is something that we talked about a little bit last week, just on regular Wealth Wednesday is that qualified charitable distributions can
Okay.
still be leveraged by her.
Okay.
And so even that is something that you can do after the fact to reduce your taxable income.
To reduce it. Wow. Wow. Okay. And so the best step for someone who is widowed, or I guess anyone who's married in that age range, should take these steps in advance. They should contact you, a financial specialist, to be able to have this information kind of broken down and strategize with them, correct?
Yeah, I mean, the best preparation is doing a lot of this before. I mean,
Yeah.
the longer runway that somebody has, the more you can kind of take advantage of this tax strategizing and prepare for it. But even if you're on the back end of it, there are still things that we can do, like those qualified charitable distributions, just to make sure that you're not paying too much to the government. Because that's something we
Right.
can all agree on. I think that
Yeah.
more money in your retirement accounts, maybe less money in the government's.
Yeah. Well, thank you, Caleb. This
Thank
was
you.
good information to think about, to plan ahead, like you said, or just things that we don't know are in existence when it comes to our taxes. And this is tax season, so thank you.
Exactly.
Yeah, so this is tax season, so it's very important for you to know all of the different loopholes or penalties or things that may affect you during this time. So Wealth Wednesday, Women's Wealth Wednesday, is here to provide this information. And if you would like more information about Foster Financial, we'll be sure to list it, and we'll be right back. This segment sponsored by Foster Financial.